For decades, the ultimate foolproof wealth-building strategy has relied on one simple idea: buy a low-cost S&P 500 index fund. The math made sense. By automatically splitting your money across the top 500 companies in the United States, you built a perfectly diversified safety net. If a few businesses failed, hundreds of others were there to catch you as the broader economy grew. But that safety net relies on a hidden mechanical flaw called market cap weighting. Market cap weighting is a structure where the more valuable a company becomes, the larger percentage of the overall fund it automatically consumes. Today, just 10 tech companies have swelled so massively that they now make up a staggering 40% of the entire index. To see how extreme this concentration has become, look at the top of the pile. NVIDIA alone will now absorb roughly 7 to 8 cents of every single dollar you invest into the entire S&P 500. You are no longer buying a broad, safe slice of the American economy. You are placing a highly concentrated, massive bet on just a handful of technology giants. Those tech giants have multi-trillion-dollar price tags, but those valuations are not based on the cash they actually earn today. They are entirely propped up by the expectation that artificial intelligence will eventually generate around $2 trillion in future revenue. To meet those massive expectations today, these companies are financing their AI infrastructure with an absolute mountain of debt. OpenAI's Sam Altman recently stated he is willing to commit $1.4 trillion to AI spending, even though his company currently pulls in a fraction of that, roughly $13 to $20 billion in yearly revenue. This creates a dangerous feedback loop. The initial hype around AI inflates the valuations of these major tech companies. Because the index fund is market cap weighted, passive investors are then automatically forced to buy more shares of these specific companies, driving their stock prices even higher. These massive tech firms are essentially passing this inflated money back and forth to each other. It looks like tremendous economic growth on paper, but current data suggests that without this specific loop of AI spending, the broader US economy would likely already be in a recession. Passive index investors are unwittingly supplying the fuel for a massive debt-driven tech bubble. Protecting your wealth right now requires stepping outside of the traditional S&P 500 system. The obvious fix seems to be an equal-weighted S&P 500 fund, where every company gets a flat 2% slice. But that introduces a flaw called negative momentum. Negative momentum is a strategy where a fund automatically sells shares of a rising stock and buys shares of a falling one, purely to keep the percentages mathematically balanced. This forces the fund to trade constantly, and those high trading fees quietly eat away at your actual profits. A more effective defense is geographical diversification. American markets have dominated for the last 14 years, which makes it easy to assume the United States will always be the unquestioned financial superpower. But look back to the year 1900. London was the financial capital of the world, and British companies controlled an incredible 24% of the global stock market. At the time, betting against the United Kingdom would have sounded completely ridiculous. The exact same thing happened in the late 1980s and early 90s. Japanese electronics and auto manufacturing were booming aggressively, that a massive portion of the investing world believed Japan was the unstoppable future, right before the American economy bounced back and reclaimed the lead. Economic leadership always rotates. Relying on a global stock market fund removes the guesswork. If another country starts outperforming the US, a global fund automatically adjusts its weight to capture that new growth, wherever it happens to emerge. We can separate the current market into distinct zones. Right now, most passive investors are trapped in what we'll call the crowded zone. They are blindly throwing capital at a few massive tech companies, locked in an incredibly expensive race to build the ultimate AI model. But underneath that is the overlooked zone. This is made up of agile, small, and mid-cap companies. They are completely avoiding the debt required to build new artificial intelligence. Instead, they simply rent cheap, interchangeable AI models from the big players and use them to solve immediate, practical business problems. Think of AI like gasoline. When a new resource becomes cheap and widely available, the massive profits don't stay with the companies spending billions to extract it. The real wealth flows to the businesses that figure out how to put that fuel into an engine and use it efficiently. Backing these agile, debt-free AI startups gives you exposure to the massive upside of the technology. More importantly, it completely removes you from the financial blast radius if the major AI infrastructure companies collapse under the weight of their own debt. Every major technological leap creates instability. It disrupts currencies and shifts global power dynamics, which is exactly why smart, institutional money is currently seeking security completely outside the traditional fiat banking system. Countries like Brazil, Russia, India, China, and South Africa, the BRICS nations, are stockpiling gold at an astonishing rate. They are quietly building alternative trade corridors to replace their reliance on the US dollar. This shift accelerated because gold was recently reclassified as a Basel III Tier 1 asset. Basel III Tier 1 is an international banking framework classification. Put simply, it means financial institutions can now legally treat physical gold exactly the same way they treat actual cash on their balance sheets. And the ultimate indicator of market defense comes from Warren Buffett. He is currently sitting on a record-breaking pile of $347.7 billion in cash and equivalents. He is a value investor, and right now, the math tells him there are almost no safe bargains left in the stock market. Institutional money isn't hoarding gold and cash because they know the exact date the market will crash. They are doing it to ensure they have the dry powder ready to buy valuable assets at a massive discount when this bubble finally bursts. Implementing this defense doesn't mean you need to abandon the S&P 500 entirely. If the massive tech gamble actually succeeds, you still want to be holding the businesses leading that growth. But you must balance that risk. Keep away from extremely hyped speculative stocks that burn money, and look toward the defensive zone. These are boring legacy businesses like Coca-Cola or Walmart. Their value comes from the fact that human beings rely on them, ensuring predictable cash flow no matter what the broader economy is doing. This chart shows how to structure a resilient portfolio today. You maintain a core foundation in the S&P, but you heavily fortify it by expanding outward into global equity funds, small-cap technology adopters, physical gold reserves, and a deep pile of cash. This requires a psychological shift. Financial safety is no longer a passive activity, absolute discipline to walk away from crowded, overly hyped trades. True generational wealth is built by being early to the opportunities that everyone else is overlooking, and it is preserved by holding enough cash to strike exactly when the rest of the world is forced to panic sell.